This is your LMAX exchange technical update for Wednesday, October 4th, 2017. Euro dollar. So although the euro has seen some support into dips, it could take some time before the market looks to retest or break down towards a measured move objective off a head and shoulders top that was triggered several sessions back that projects that decline down towards 115.55. If we see rallies, it doesn't mean that the market's looking for a bullish resumption just yet, and the market should find resistance up towards some internal resistance in the 119 area, ideally ahead of a continuation of declines down towards that objective at 115.55, which roughly coincides with the 100-day moving average. Sterling dollar. Cable is broken down through that previous peak from August, and there is room for setbacks to extend some more, even towards the 130 area. But ultimately, this is a market that is now favoring the top side, and setbacks are viewed as corrective in 2017, following a breakout earlier this year above 27.75 that had suggested the market is putting in a longer-term base off the plus 30-year low from October of 2016. And so setbacks that we do see, if they do extend some more down towards 130, they should be supported in favor of that next major upside extension back above the 2017 high up towards 137, and then exposing a move through the psychological barrier at 140. Dollar yen. Dollar yen has been trading higher over the past several sessions since basing out by 2017 low at 107.32. There is room for the market to extend this run up towards next key resistance, which is range resistance for much of this year around 114.50. But if we do get up there, the market again is confined to a range right now, and so the expectation is that we could stall out again ahead of that next downside extension, potentially taking us back down towards and below that 107.32 low from 2017 that was set back in September. Euro Swiss. Euro Swiss isn't doing much at all right now, but following a bullish breakout that we saw earlier this year above 110 and then above 112, the structure is constructive, and eventually this consolidation should be broken, opening the door for the next major upside extension through the current yearly high at 116.24 and towards 120 further up. Only back below 112 here would compromise that outlook. Aussie dollar. So Aussie is broken down below 78, and the breakdown does warn that the market could be looking for a deeper setback, which could take us towards the 75 area over the coming sessions. At the same time, if the market is unable to establish a close below 78, it will leave the possibility for the market to trade higher again. Though again, ultimately, it looks like this market is now showing signs of topping out in 2017, and rallies should be well capped, certainly ahead of 80. Dollar CAD. So dollar CAD has entered a period of correction after putting in a plus 2-year low down at 120.62, just ahead of that 120 barrier, and there's room now for this market to continue higher and back towards a retest of that August peak that we had seen at 127.80. Any setback should be supported again in favor of a higher low and a continuation of this correction after the market broke down significantly off the 2017 high from back in May all the way up near 140. Kiwi dollar. The New Zealand dollar has been very well capped into rallies of late since topping out back in the month of July at 75.58. Since then, we've seen the market now stall out above 74 and a clear break below 71.32. Recent support would confirm a lower top at 74.32 about in favor of the next downside extension back towards a retest of the 2017 low in the 68s. SPX 500. The S&P 500 continues with its record run, and there is scope for this market to extend now up towards a psychological barrier at 25.50, which is that next resistance point. At the same time, if the market is going to look to reverse course, it will need to establish back below some critical support right now on a short-term basis that comes in at 24.87. That's the low from the 25th of September. Gold. So while gold has seen some intense setbacks over the past several sessions, the market has been very well supported on dips over the past several months, despite some of those dips being quite intense. And so the market is expected once again to be supported into this dip, ideally in the 1250 area or ahead of 1250, ahead of the next upside extension back towards and above the 2017 high at 1357, and through the 2016 peak at 1375 further up. Only back below 1200 would compromise the outlook for gold.